In the high-stakes, multi-billion-dollar game of early-stage venture capital, investors are trained to obsess over a specific set of catastrophic risks. They worry about market size risk, technical execution risk, regulatory backlash, and ferocious competition from entrenched tech monopolies. For decades, the implicit contract between a venture capitalist and a founder was sacred. The VC supplies millions of dollars of high-risk catalytic capital, and the founder pledges to dedicate 7 to 10 years of their life to building a generational, market-defining enterprise. In 2026, amidst the most chaotic, hyper-capitalized artificial intelligence gold rush in corporate history, that sacred contract has completely broken down. A terrifying new existential threat has emerged that keeps top-tier seed investors awake at night. It is not that the technology will fail. It is not that the market is too small. It is the sudden, stark realization that after handing a founder millions of dollars, that founder will simply pack their bags, abandon the company, and walk away. Across Silicon Valley, New York, and London, a silent panic is spreading through boardrooms. Early-stage venture capitalists are walking into pitch meetings and asking a question that would have been unthinkable just 3 years ago. They look founders dead in the eye and ask, "Will you sell out to an AI lab in 12 months? Will you quit on me?" To understand why the world's most sophisticated investors are suddenly plagued by paranoid insecurity, you have to examine how the unprecedented arms race for frontier artificial intelligence talent has shattered the fundamental economics of venture capital. Consider the painful reality experienced by Pete Soderling, founding partner at London and San Francisco venture firm Zero Prime Ventures. Soderling was preparing to lead a major seed investment into a promising, London-based startup founded by a team of world-class artificial intelligence researchers. The business model was compelling, the technical architecture was sound, and both parties had successfully negotiated and signed the term sheet. But right before the funds were wired, one of the core co-founders abruptly resigned. He hadn't been lured away by a rival startup, nor had he suffered a sudden personal crisis. He had simply been poached by a major frontier AI lab offering an astronomical compensation package. With one half of the technical brain trust gone overnight, the startup collapsed before it even launched, and the investment deal was instantly scuttled. As Soderling solemnly noted, this aggressive assault on founding teams is no longer an isolated anomaly. It is happening at every single stage of the startup lifecycle. What we are witnessing across the global tech ecosystem is a massive predatory wave of founder poaching and so-called acquihires. In traditional corporate finance, a merger or acquisition is designed to purchase a company's commercial assets, intellectual property, customer relationships, and recurring revenue. But in the current AI frenzy, corporate development teams at tech giants and frontier labs like Anthropic, OpenAI, Google, and Meta don't care about the startup's product, its existing customers, or its long-term commercial roadmap. They care about one thing only: acquiring the raw human engineering intelligence behind the code. For early-stage venture capitalists, this wave of acquihires is proving to be financially catastrophic. The foundational math of venture capital relies entirely on the power law. In a typical venture portfolio of 20 companies, 15 will fail or break even. 3 will generate modest returns, and 1 or 2 massive, home-run outliers must return 50 to 100 times the entire fund to make the business model work. The power law requires time, patience, and massive enterprise scaling. When a frontier AI lab swoops in and acquihires an AI startup 18 months after its founding, it completely destroys the power law. These acquihire deals are meticulously engineered by corporate buyers to reward the founders while utterly screwing over the early investors. The acquiring tech giant typically structured the deal to pay just enough cash for the startup's assets to satisfy the investor's basic liquidation preference, returning the VC's original principal dollar for dollar with zero capital appreciation. Meanwhile, the acquiring lab turns around and hands the young founders eye-watering, multi-million-dollar equity packages, massive sign-on bonuses, and guaranteed multi-year retention packages in the form of restricted stock units. The founder walks away a newly minted multimillionaire with zero personal downside. The venture capitalist, who took the ultimate early-stage technical risk when the company was just an idea on a napkin, gets handed back their original check with a 0% return on investment, having wasted 18 months of fund deployment cycles. As Pete Soderling observed, these early acquihires are structured to be extremely lucrative for the founders, but savagely punitive to the venture backers. The statistical scale of this phenomenon is staggering. According to proprietary industry data from PitchBook, the number of venture-backed startup acquisitions in the United States AI and machine learning sector with undisclosed deal values, a metric that almost universally indicates a team acquihire, exploded from 181 deals in 2024 to 322 deals in 2025. In 2026, the frenzy has accelerated even further, with 245 acquihires executed through early July alone. This intense corporate raiding has created an unprecedented feeding frenzy in tech hubs like San Francisco. Sherwood Callaway, founder and chief executive officer of San Francisco-based AI startup Sazabi, described the current market environment as absolute chaos. Callaway noted that the moment Sazabi emerged from stealth mode, his inbox was flooded by corporate development teams from at least 3 major tech behemoths attempting to initiate acquisition and acquihire discussions. He remarked that corp dev teams are everywhere right now, hunting down technical founders before they even have a chance to build a real product. Callaway, a repeat founder with significant long-term ambitions, has publicly stated that he refuses to sell. He recognizes that abandoning his startup for a quick corporate payout would inflict long-term damage on his reputation as a builder. But Callaway candidly admitted why so many young first-time AI founders are succumbing to the temptation. In today's hyper-capitalized market, launching an AI startup has effectively become the ultimate low-risk backdoor interview for a high-paying corporate job. As Callaway famously put it, starting an AI company today is simply a very nice, highly lucrative way to get a job at Anthropic. In the past, quitting a high-paying job to launch a startup carried immense personal financial risk. If your startup failed, you burned through your personal savings, damaged your resume, and faced professional embarrassment. Today, the game theory has inverted. A talented machine learning researcher can raise $2 million on a napkin, spend 18 months experimenting on the VC's dime, draw a comfortable founder's salary, build a cool prototype, and if the going gets tough or the tech hits a wall, quietly sell the team to a major AI lab. The founder suffers zero financial downside, takes zero personal risk, and lands a golden handshake senior research role at a company like Anthropic or Google with a massive compensation package. Ironically, venture capitalists themselves played a central role in creating the very monster that is now consuming them. During the chaotic AI capital flood of recent years, VCs competed so aggressively for hot AI research talent that they completely surrendered their institutional discipline and legal protections. In their desperate bid to win deals, VCs pushed early-stage investment instruments like safes, simple agreements for future equity, to extreme lengths. Safes are highly founder-friendly legal documents that allow startups to raise millions of dollars without setting an immediate valuation, without granting investors board seats, and without giving VCs voting control or liquidation governance. Early-stage investors flooded unproven founders with millions of dollars in capital on non-binding, protection-free terms, effectively writing blank checks to teams with zero operational oversight. By stripping away traditional investor safeguards, VCs created a massive moral hazard. When a frontier lab comes knocking on a startup's door with a tempting offer, the VCs have no board seats to block the sale, no voting control to veto the transaction, and no legal leverage to force the founder to stay. They are completely helpless observers watching their portfolio companies get dismantled from the inside out.
We cannot move forward.
The resulting tension in boardroom meetings is palpable.
The risk is necessary for this
Founders
level of
report
return.
that during recent
The
fundraising
technology
rounds,
is sound.
while VCs rarely ask outright if the team plans to quit, they drop tense, half-joking warnings into pitch meetings. VCs make nervous jokes like, "Just promise us you won't sell out to Datadog in 12 months," attempting to mask their deep institutional anxiety with casual humor. Now, top-tier venture firms are initiating a fierce counteroffensive to protect their business model. VCs are completely overhauling their due diligence playbooks, pivoting away from pure technical evaluation toward intense psychological interrogation. Jonathan Lair, co-founder and general partner at seed-stage firm Workbench, explained that VC diligence is no longer just about reviewing code or analyzing market size.
The vision you laid out, it's truly
Lair
compelling.
now takes
But how do you
prospective
scale the
founders
avatar
out for
integration?
long,
That's where the next
multi-hour
round of
dinners,
funding comes in.
digging
We've
deep into
projected
their
growth
personal life
stabilizing by
stories,
Q3.
childhood motivations, and core moral values. Lair uses these dinners to filter out transactional mercenaries from true missionary founders. He asks point-blank questions about exit scenarios to observe the founders' micro-expressions, looking for signs of genuine determination versus opportunistic careerism. Similarly, VCs across the industry are completely restructuring their investment term sheets. They are abandoning uncapped safes and demanding priced equity rounds that include board seats, information rights, and explicit investor consent clauses for any M&A activity or asset sales. Furthermore, VCs are enforcing strict, non-negotiable founder equity vesting schedules with double trigger acceleration restrictions, ensuring that if a founder walks away during an acquihire, they forfeit their unvested equity and walk away with nothing. The ultimate lesson for founders, investors, and business leaders navigating this landscape is crystal clear. Capital is no longer the scarce resource in Silicon Valley. Relentless, missionary human commitment is. In an era where tech giants can print infinite cash to buy up technical talent, the most valuable asset in the entire venture ecosystem is a founder who possesses the unyielding grit to resist the quick payout, weather the brutal storms of entrepreneurship, and build an enduring, independent empire. If you found this deep dive commercial autopsy insightful, please smash that like button right now. Drop a comment down below with your thoughts on whether AI founders are justified in taking the quick payout or if they owe it to their investors to play the long game. Share this video with a founder, investor, or tech leader who needs to understand the real capital dynamics behind the AI hype. And don't forget to subscribe to Solo Level Up so you never miss an institutional breakdown of the world's most aggressive business strategies. Thank you for watching, and I will see you in the next analysis.